Warren Hogan, welcome to Property Insights, mate.
Thanks for having me on, Mark. Finally.
Finally. Well, I wanted to get you on when you first came out. By the way, I should introduce you. You're the economist at Judo Bank, one of my favourite banks, by the way.
Very good.
And a great team there. And I was one of your very early, not yours, Judo Bank's very early fans, and I still am. And I should declare that Judo Bank is on our panel and Yellow Brick Road, and we are a big advocate for Judo Bank.
Very good one.
I've done my
advocacy,
and I've also done my the qualifications. But I wanted to get you on when you were probably the first economist who was prepared to go public or into the media and stand by your position that in order to control inflation as we know it, as I'm talking about now, maybe 6 months ago.
Yeah, it's April, I think.
Yeah, and which is about 6 months ago, where in order to control inflation, the Reserve Bank, you were saying the Reserve Bank actually has to pull the interest rate lever up. In other words, go another, and I think you might have suggested maybe 2 more rate rises.
Yeah, I came out with 3 then. But
three
that was a
it?
bit bullish.
Yeah, but the data of the time might have indicated it.
Well, it's the number. It's the number of where you got to get the real interest rate to, but we can talk about that.
Yeah, well, that's what I want to talk about. So, I do the podcast with Kooky.
Yeah.
And we've had Chris Joy sitting in there. So Chris Joy is in your camp, or Chris was. I'm not sure if he still is. I bumped into him yesterday. I should have asked him, but Chris did put out a note on Coolabah about prior to the last meeting, I'd say a week or two prior to the last meeting, and said that the Reserve Bank needs to put the rates up again. And that he was expecting another rate rise. And then after that, there will be a crash. There'll be a recession.
Very optimistic.
Yeah. So, and then Koukoulas is more in the dovish territory in terms of rate increases. He's saying there's enough and that's enough and time will sort it out. Are you still in the give us a rate rise territory?
Yeah, I've still got a rate hike in for November and cheeky little 15 basis point hike in December to get us to 475. Whether it'll happen, I don't know. All I know is that any other Reserve Bank board would have had the cash rate up around 5.5% probably last year. They're trying to experiment. Earlier this year, there was recovery in business activity in Australia and the recovery in employment suggested the experiment wasn't working. We've now just about run out of all of our nominal tightening. The change in the cash rates washed its way through the system. It takes 12 to 18 months.
Yep.
And that leaves us with the real interest rate. And the real interest rate is barely above zero. And that's what economists actually model and analyse the economy, just like real GDP, real wages, all that stuff. I'm actually aghast at the lack of reference to real interest rates in the professional economist community.
Can you explain that then to the audience?
Yeah, it's just simply the interest rate minus inflation. It's just like, you look at your wage growth and if it's 4%.
You're talking about cash rate, of course.
Yeah, well, you can use anything. I use the 90-day bank bill just to give a sense of what banks have to pay for mortgages.
I often refer to it as a net zero. I refer to the real interest rate as net zero. So that's the cash rate minus inflation.
And that's about where it is now and has been for the last 6 months. But you put aside the 10 years before the pandemic, history of this country and all others shows you it needs to be at least at the long run rate of growth, which in this country is around 2.5, or even higher to get rid of inflation. In fact, a zero real interest rate would have been the grounds for creating inflation in most of our past. So everything I'm watching as it plays out is playing into this. Look, this slow, drawn out process is weighing on the economy, there's no doubt. But business,
or a part of the economy.
Yeah, and it's very uneven, as we know, and we've had all those discussions. And look, I think now as we're sitting here in September, that the Reserve Bank actually probably regrets not just doing what they needed to do. The experiments failed.
Can we talk about the experiment? I mean, obviously they haven't said experiment, but
they have.
They have?
Yeah, the deputy governor's called an experiment.
When she was deputy? Before
the
new deputy?
Andrew Hauser, the new deputy,
right,
about 2 months ago, yeah. I mean, it's essentially this idea that you want to try and, maintain the gains of the labour market from the pandemic. Well, we've done that in spades. We've created 318,000 jobs in the first 7 months of this year, which is just off the charts. We averaged before the pandemic 17,000 a month to keep unemployment steady, and we're getting 50-odd thousand now. I mean, this is a booming jobs market, and that's why the bottom end of the housing market's doing well. Anything under 1 million countrywide is probably going very well because we're creating incomes and demand for housing, and people have got the income and the access to credit to go and buy those cheaper homes. What are now cheaper homes?
Can you tell? Would you mind opining on how much contribution in terms of the jobs market the federal government and also state governments have done in terms of their spending?
Yeah, it's huge, especially this year.
The last budget, for sure.
Yeah, well, it's actually the debate that started in the last week or so is right on. The government spending not only in creating jobs in the public service, and a lot of them are important frontline jobs around. In fact, we can't get enough teachers and nurses and police people and all this sort of stuff. But they are creating bureaucrats, particularly at the state level. And of course, then they're throwing money into things that are private sector jobs, but driven by the public sector, like the NDIS and various other programs like that. So they are dominating it, but it actually doesn't matter because it's income in the economy. And you're seeing that in the housing market, that people have, buy $500,000-$600,000 homes because they've got a job. It feels like a secure job. It's great, but have we got the balance right? And look, I actually think the experiment's a bit of a fluff. What it was that all of us, both of us included, when we were on this march up in rates 2 years ago, were worried about our massive exposure to variable mortgage rates. We're the only country in the world that has sort of 80-90% variable. And all of us thought 400 basis points, this is going to knock the wind out of the place. And all of us have got to be honest with ourselves. It's unbelievable how well this economy's performed.
And what do you put that down to?
Most people were not paying at the zero. They were paying off their mortgage ahead of time. Yeah. And most people are sensible, right? I mean, this idea, so much of the commentary, if you look at it in terms of the macro economy, if you apply it down to the individual level, it says you're a bunch of idiots. You're making bad decisions. I've been doing this for 30 years and people don't generally, in mass, make bad decisions. So, look, we had a lot more resilience in there. Michelle Bullock, when she was deputy, actually gave a speech about 18 months ago when she got first made deputy, doing the analysis of all these securitized bundles of mortgages and said, actually, there's heaps of wiggle room in here.
Yeah, I remember it. Yeah.
Yeah, and no one sort of listened to it. But, look, that was what we were worried about, and I think that sort of worry about the exposure we had to higher rates then morphed into this experiment. But we've created, probably over 1 million jobs since the pandemic. And I mean, maintaining the gains of the pandemic, we've done that and then some. So look, if the inflation goes away, fine, that's great. I hope I'm wrong. I've been saying I hope I'm wrong a lot the last 2 years. But, it doesn't just go away, and it's insidious and it's destructive, and it's the thing that destroys open and free economies. And it's the thing that destroys open and free societies. So,
can I just go back and then talk to you about this? So this correlation between the unemployment rate as opposed to employment rate, or the rate of employment, the unemployment rate, and the fact that I think we're sitting at unemployment is 4.1 or 4.2 now, right now. Where do you think, because there has been some references in some of her more recent statements and or public appearances, she has been indicating that unemployment is, these aren't her words, but unemployment is too low. I do remember reading a paper that she wrote when she was deputy governor that talked about a non-accelerating inflation rate of unemployment of around 4.5%. Which sort of indicates to me that at the time would have been the rate of unemployment that she would like to see that would probably cure inflation or the cost of living.
Yeah, well, get us back into balance.
Or at least. Where do you think they're not talking about it, but where do you think they secretly, unless they've already revealed it, where they would like to see unemployment as an indicator for people listening to this? Well, shit, if they head towards that number, if they as they tend towards that number mathematically, we're likely to see a rate reduction because that's likely the same time that we're going to start to see inflation get to the territory they want it to be.
Yeah. So I think the accepted wisdom at the moment, and the RBA's thinking is 4.5 is about the right number. It's a bit low. And if you can fine tune it when you're trying to shift the Titanic, this big economy, if you can see it go to 5 and then come back to 4.5 pretty quickly after that, then you've done a great job. So I'd say the signal for a rate cut is likely that pathway between 4.5 and 5. But I just warn on a couple of things with the unemployment rate at the moment. First of all, we've had an unprecedented surge in population. So asking the RBA and anyone to keep up with all these extra heads to find jobs for it's an absolute miracle. It's the unemployment rate's not a 6.
I can't understand. And by the way, it is in 6 and 6.2 in Europe and 6.2 in Canada and 6 something like that in the UK. Like, US is different, but North America is different. But like, we're so far out of kilter with the rest of the world, not only in terms of our cash rate or our official rate, but also with our unemployment number. Other than the US. And is there politics around this?
Oh, definitely there is, and I think the politics is now really it's all coming to a head right now. Last few weeks, something's going to give in the next little while, and I think it'll be a rate hike.
But how does that work, Warren? Like, I mean, she's not being told by Jim what to do, our treasurer. But is she? Like, I don't understand. Like, how this experiment? Why is it an experiment? Like, how does all this work in terms of their thinking?
I think my view on the political problem the RBA board has is twofold. One is they have a government which is a lot more vocal and a lot more clear in their views on where interest rates
and can be critical.
Yeah, as we've seen in the last little while. So that's a real issue. Then, the coalition have copped 2 rate hikes in election campaigns, and these guys are sort of whinging about one a year out. But anyway, they're cognizant of that. But that being said, treasurers come and go. Prime ministers come and go. That's not the issue. What I think they're worried about is their standing in the community. So
reputation.
Broader support. The Reserve Bank is one of Australia's finest institutions of the last 30 years, a big part of our modern prosperity. And that toughness that came with it. I mean, Glenn Stevens was disliked regularly for raising rates, but he did the right thing. And I think after the problems of the guidance in the pandemic, which was really stupid, and I wrote about it in the AFR at the time, and I didn't know inflation was like going around the corner, but it was a really stupid idea. And I think the other thing is that the RBA was telling everyone in late 21 and early 22, we're different from the rest of the world. We had our heavy lockdowns late. We got knocked out of kilter. We got a 6-month head start. Lucky country. No, the RBA said we're different. No, we're the same. We got a head start. Get on with it. And they didn't. So they've made these pretty bad errors, the likes of which they haven't done in the last 30 years. And I think if with no political cover from Canberra, if they hike and then the economy collapses, that scares them. That's what really keeps Michelle Bullock awake at night, in my view, is that they are seen to trigger some sort of significant downturn, and it just works on top of this other stuff.
And I don't think the Treasurer has helped, because he sort of pretty much put the headlights on and basically said, you're causing Australia a problem at the moment. If she then puts the rates up, he will go to that's.
I think that's why
nuclear.
We've had such a visceral response in the broader community from people like me to the comments from the Treasurer talking about smashing the economy before the national accounts, and then of course it's all played out since. Is because the thinking was, look, they're not going to get any political cover, and if they hike again, they're going to basically have Canberra pointing at them saying, blame them.
Yeah, that you're the one.
But they're actually doing that now, and they haven't hiked. They're doing it even though under instruction, under agreement, under the experiment, they're keeping our rates lower. It's really dangerous. They're leaving Australia exposed to inflation that's really destructive. There's no guarantee that it's gone overseas, remember. This is something that people sit there and think, it's all fine overseas. But their inflation's been held down by the big fall in goods prices, which was the original shock. Remember when it came in, and the Fed said it's transitory?
Yeah,
it's transitory. It just takes 3 years. These things don't happen quickly. So the services inflation in America, Europe, everywhere is still running at 4 to 5.
What is that?
Well, it's just everything. Our economy is 80% services. So everything from your dentist to your chemist to your vet, it's all of this stuff that we mainly spend our money on. And it's why it's regarded as domestic, because it's not internationally traded, it's local, and it's happening everywhere. And it's because money was so cheap and there was so much fiscal stimulus. And to be fair, our government's doing a little bit better on this front, but in Europe and America, they're just pumping money into these economies with massive deficits. We get some stability in these economies. If the Fed cuts 4 or 5 times in the next 6 months and the economy responds positively, watch out. This is like the mid-70s.
They're going to put it back up again.
And that's, if you look at the history, that was the disaster
Yeah.
in the late 70s. So, look, we're very vulnerable to that because we didn't even get up to those levels. I mean, think about the Fed. They're going to cut next week or, at the end of September, and they can cut then 3 more times before Christmas. And their interest rate is still above ours here in Australia. I mean, it's absolutely crazy how far out of whack we are. And now their real interest rate right now is 5.5%, the funds rate, their short-term interest rate, minus a 3.1% core inflation rate. So what's it, 2.4? Their long-term gross is about 2.25. It's a little bit tight.
Yeah.
We're at 4.35 with inflation of, let's call it 3.9.
Yeah.
So we're at 0.5%. So that's the problem I have. And as an economist who I'm not doing this for anyone. I'm doing this for the broader community. I've been doing it for long enough. That's my warning is, and it's been right. You can hear what the Reserve Bank's saying. They've got their finger on the trigger. Any other central bank that we've had in the last 30 years, whether it's Glenn Stevens, Phil Lowe, Ian Macfarlane, they would have hiked in May and they would have hiked again in August.
And do you think at the end of the day, the reason that they're not doing it, the reason they're having this experiment, so to call it, is to protect the reputation because they're worried about the back channels and the flack they're going to cop?
And the media.
That's what I'm talking about, back channels.
Yeah. Well, it's really pretty obvious. I mean, there's this whole swathe of the media that sort of views this whole thing. I'm amazed at how people can even see like slightly higher interest rates as any payoff for the devastation that's been done by inflation. It's destroying people's lives who are low and middle income earners. We don't see it every day because these are people who don't hear about. It's happening though, and their living standards are going backwards big time. So, there's a big part of the community that, wants them to cut rates for political reasons, not just the politicians, but the whole ALP base is now being trained to say rate cut is required, rate hike is absolutely devastating. Let's call that 25% of the population. It's baked in, no analytical economics about it whatsoever. That's just a view. It's a political view. I mean, this is House's false prophets, right? The Deputy Governor's speech. I mean, I've been doing this for a long time, Mark, as you know, and a lot of people have an end game in mind. Where's the cash rate going? What's the economy doing? What's the unemployment rate doing? That's not scientific. None of us know the future. So my job as a forecaster is put forward a proposition and a series of pathways. And then the scientific method says, I look at everything to disprove why I'm right. And that's not what most people do. Most people look at things to make themselves feel like they're on the right track. And that's why this is the worst economic debate this country's ever seen, or I've ever seen in 30 years.
Well, it's not a debate. That's the problem.
Well, it's just horrible.
Do you think there's, given where interest rates are, and let's say we don't have a rate rise, but we definitely don't have a rate reduction, do you see the recession, given the national accounts more recently, do you see end of when I think it comes out again at the end of January or something like that. Do you see us in negative?
Not necessarily, no.
And what's propping us up either?
Well, we're getting a big kick right now, though we haven't seen it in the data yet from the tax cuts. This is $25 billion.
Yeah.
My argument about, this is all the fault of interest rates is wrong is partly because one of the biggest hits to household financial positions has been bracket creep. It's been worth. If we didn't have any bracket creep in the last 3 years, I reckon it's $60 billion a year now. So we got $25 billion tax cut. It's actually just halting bracket creep this year. It's not. It's only a year.
It's only a year's worth. Yeah.
But that'll give it a kick. And then there's the cost of living subsidies. But this employment. And the other thing is, people, economists view this immigration as like almost a linear. They're here, they're spending. It's not what people tell me about the way immigration works. That 1 million people, we're yet to see their impact on this economy, and it'll be positive.
Well, shit, if that's right, then
they're going to need houses. They're going to need to go to Harvey Norman.
Yeah,
they're going to need to do a lot of things which they don't do in the first 6 months they're here.
And if they've got jobs, they will be able to do it.
It takes time. And so there's a lot of reasons to think this economy is actually going to go right. It won't grow much. This is the other thing that a lot of economists in the last month or so have been trying to get across in the broader community. The economy's capacity constraint. We've only got so many skilled people. We've only got so many cranes. We've only got so many factories. We've only got so many hospitals, and we've got this big bulge of population and all this money being thrown in the economy in the last 5 years, and it's just growing out of its skin. And that's why the Reserve Bank's saying we've got to, it's a bit too hot. And then the Treasurer is saying, well, it looks weak to me. It's hot. And it's not hot because it's hot what we knew in the old days of 4 or 5% growth. It's hot because the economy can't grow by more than 1%. We're lucky to get that.
Because of capacity?
Capacity, yeah. We've only got so many skills. We've only got so much capital. We've only got so much equipment. I mean, it grows every year, but at the moment, the government's actually doing the growing, and it's potentially crowding out the private sector, which will reduce the ability for us to grow our capacity. But businesses are still investing, which is good news. And governments are investing in infrastructure, which I'll never get up them for that because we are always behind on infrastructure in this country.
But what about where they're investing in employment?
Yeah, well, I actually think I was talking about unemployment before. Look, the thing is that one of the big changes in our economy, which people just don't seem to be wrapping their head around, is we've seen this massive demographic shift, the retirement of the baby boomers. It's a 60-year cyclical shift in a thing called the dependency ratio, which is the ratio of people who do not work in the economy to those that of the overall economy, so young and old versus the overall economy. And of course, dependency has been falling as the baby boomers came into the workforce, and that meant more and more labour versus the total consumption, total population, and therefore wages pressures were kept under control. And of course, we had excess labour. Unemployment has been the problem in most countries for the last 60 years, top of mind for economists. That's gone.
Well,
labour shortages are here forever now.
Labour shortages, yeah.
That's the new unemployment.
As opposed to unemployment being a problem.
Yeah. And then if we don't recognise that, then we won't do the things we need to. But most importantly, what we need is a microeconomic approach to the labour market because we've got a massive skills mismatch. We've got to get people who are going to lose jobs because of AI or whatever it is, or just changing industry structure, and retrain them mid-career. I mean, we've been talking about this for 15 years about people having to change careers. Well, now's the time for it to happen because the economy is actually going to change radically in the next decade. AI is going to play a huge role. And if we can harness this, the wealth that's going to be created for this country, as countries all around the world, is like nothing we've seen. It is the hugest thing in 200 years.
Are you? And that sounds like a massive structural shift. But are you disappointed in the way this government is approaching our economy?
Yeah. I always give them a chance. I'm what you might call a swinging voter. I've never been a member of a party because of what I do. And Jim came out and said, we're going to have a conversation. And that was the first budget and the second budget. But look, they're just growing government, care economy. It all comes from the pandemic, this idea that everyone needs to be looked after, this idea that we're such a wealthy country that we can focus on that. And that's fine. I think we all agree we'd love to do that. But what we got to understand is we're not a wealthy country simply because we've got heaps of stuff to dig out of the ground or we've got a great agricultural base. We're one of the wealthiest countries in the world because our economy is hot shot. It was a market economy. Price signals work. Great capital markets. You've lived it. You've seen it, how much wealth it can create, how much people can get capital to invest in the right industries. Well, that's all being wound back by big government crowding out the private sector, lots of IR regulation, stopping the labour market flexibility. And I think this is going to be a disaster because we're basically unwinding what Hawke and Keating did. And Hawke is the greatest Australian Prime Minister of all time because of what he did despite his base. And these guys are actually unwinding it. They're going back to Whitlam, and it's a disaster.
But that's sort of a little bit surprising given that Jim did his PhD on Paul Keating.
Yeah.
I mean, it is a bit surprising.
Oh, look, it is. I mean, I think they're just looking for the big vision, right? And they've got one, this whole idea of the fourth economy and, the mission economy.
Fourth economy being the government?
Yeah. I really
or the government sector. I mean, what do you mean by the fourth economy?
Well, I don't know. That's just what he talks about. I think it's all about the energy transition and yeah. So look, that's all great, but it's actually not the vision for the economy. That's like something we have to do. I remember a banker, I won't rename them, said, "Oh, we're going all IT, we're doing agile, we're doing all this," and I just looked and thought, that's not a business strategy. That's a business necessity.
Yeah.
Anyway, the point I'm getting at is if we undermine how effective our free market economy is, we're not going to get the kind of resource allocation and investment and business confidence and that animal spirits in our SME sector, which, as you know, I look at a lot. We're going to snuff it out. It'll take years, and by the time you do it, it's gone. And we're already seeing it. Our living standards have taken a massive step back already. And I would hate to see this continue, particularly as we're on the cusp of this great industrial revolution. That's the real thing. And it's all about labour shortages, and it's all about that incentive for business to go and invest in labour-saving technology. I was staying at the Gold Coast on the weekend. I saw two guys cleaning the outside of one of the big apartment blocks. That no one's going to be doing that in 10 years. Drones will be doing that. You know, we've got this it's unbelievable. I mean, the whole history of these revolutions, starting with the first one in Britain, was about freeing up labour to go and do something else. And that's what this will do. We've got to do it because of labour shortages, but it'll also free up labour to go and work in the care economy or whatever it is. But we've got to get that right. And, of course, we want our market signals working right so businesses are investing.
So you're actually just talking about the government, and it's not just the elected politicians, it's everyone below them, all the advisors.
The bureaucrats.
All the people sit below them. You're talking about actual kicking off real proper structural change.
Well, no. I mean, I actually think our economy's broadly been working pretty well for the last 30 years. I'm just sort of saying make sure it keeps working, you know. So, you know, if anything, our IR system was tightening up before these guys came in, and then they've gone another level and they've got the issues with the unions. You can see in terms of size of government, the problem with the size of government now is if you're in a world of labour shortages, which we are, as opposed to the old world of labour abundance, unemployment being the problem, you go and do all these care economy jobs in NDIS, well, you're going out and paying up to hire people that the next small business person can't hire.
Correct.
You're squeezing them out.
And if you want to get them, they've got to pay more. And if I'm going to pay more, I'm going to push my prices up.
That's the essence of it. So you go back to the start of this year in terms of the cycle. I was in the same camp as everyone else. The consumer had slowed. Business wouldn't be able to pass on cost pressures. They would have a P&L hit. They'd pull back on hiring and investment. That's happened mildly, but business has been resilient and they've been able to keep passing things through. And then the government's gone and thrown money at the economy. So
can I stop you there because that's an interesting point. So you mentioned chemists and dentists and blah, blah, blah. Why do businesses, or how is it that businesses have been actually able to pass it through, or more importantly, how is it consumers have actually accepted and paid it? Is that because they're all employed in big government? I mean,
no. I think
where is that?
I think there's a couple of things. One is that, you know, this idea, we've still got inflation expectations anchored. Well, I'd be careful.
So they cop it.
Well, people have lost their bearings. They walk into Coles now, and it's like, you know, prior to the pandemic, you know, all these people shopping, I was like, you know, knew everything.
Yeah, you knew pack.
You walk in now, and it's just chaos. Okay, I'll just have that. Geez, the steak's expensive. You know, whatever it is.
Yeah.
You lost your bearings, so that's worrying. But the reality is that people have access to credit or liquidity in the household sector in this country like never before. I mean, your whole career has been built off the back of that. I accessed credit by the retail sector that came out of the deregulation, the 80s, the 90s, and then all the wonderful innovations.
That's Keating did the deregulation.
But it opened up the financial system, right? But now people have redraws.
Yeah.
Even if you've got none left in that, ring up your bank, extend by 50 grand, done, on the phone, in a week.
Yeah.
So think about it this way. Despite all the problems about retail spending and everyone's talking about, the reality is real retail sales in this country are still 8% above where they were in 2019, right? Let's talk about consumption. Let's even say it's only 1% above. Income is down 8%. How's that work? Well, saving less, borrowing, not paying off the mortgage as much. It's what economists call consumption smoothing. So you take a hit to your income, the last thing you're going to do is suddenly change your lifestyle. You know, you still want to go to the snow, you still want your children going there, et cetera, et cetera. So you consumption smooth, you fill in the gap, you save less, your balance sheet deteriorates for a period of a few years, and only when you think this is a permanent state of affairs do you then make the big adjustments. Now, there's no doubt that's been happening at the individual level across this economy, but en masse, Australians still have this confidence in our future, which I see in the SME sector. I can see it in the way consumers are behaving, that they're willing to run down their long-term financial position to keep things going. It would be an absolute tragedy if we ended up giving up on our future like that, because I think in our bones, people know that all the foundations of what made this country great are still there, whether it's the resources, the agriculture, the good capital markets, the immigration, all the things. You know, we hassle our politicians and stuff out, but they're actually generally pretty sensible. So I just think that we've got this great future and we just want the economy to operate as effectively as possible. Right now, with the economy at capacity, you've got to be careful. In fact, we may need a bit of short-term pain in order to get ourselves back onto a sustainable path with inflation low, and then we can really roar ahead into the rest of this decade.
How much do you think the wealth effect, particularly where the contribution property makes, is contributing to consumers being prepared to pay more and save less.
I think that's been a big part because, as I said before, that example of the redraw or the extending the loan and how easy it is, but also the confidence is
the difference between what I owe and what I'm the place is worth.
Yeah, well, say
it keeps going up.
You sort of been hanging in there for a year and a half, and then earlier this year, you got a bit of a debt built up on something or a credit card, and your house price has gone up by 50 grand. I'm talking about the average Australian, not, wealthy people. They go, well, actually, I can go and
I'm going okay.
I can get, one of the
50.
banks to give me 20 and just cover that, and then I'm back off again.
Yeah.
So that all reflects this great confidence. And of course, underpin that, of course, is the equity in housing.
Yeah.
Which, again, we've got to protect that, I mean, I don't see a major problem. I can see 10% down at some stage, but that's not a big deal. It's a 40-year asset. It'll be a bit disruptive, you'll know better than anyone in the short term, but that's – and I think it's real because we don't have enough property. We don't have enough dwellings in this country, and we certainly are not looking like we're going to
And we
deal
won't
with
have enough either.
Oh, not for 3 to 5 years.
No, it's just not going to happen because the cost of everything's just too ridiculous. I mean, the infrastructure is just no good. Getting approvals, the confidence of developers to come back in the marketplace, et cetera, is just going to keep going on. I got one really important question I want to ask you. It's a bit political, but and you may or may not choose to answer, but Matt Comyn has recently come out and said, and I actually agree with him, and I've had the same conversation with Jim Chalmers, but Matt has come out and suggested we increase GST. We zoom it. We have have a fixed rate of 10%, but with a variable rate sitting in there between 10 and 15, up and down, in lockstep with the RBA.
Yeah.
What do you think about that?
Yeah. And Phil Lowe actually mentioned this on his way out that, we need to complement the independent central bank and monetary policy with an element of fiscal policy that is also independent.
Without changing taxes.
Yeah, well, you can raise the GST as an easy one. You could actually...
I mean income taxes. I mean GST it's not looking like
Mark,
a tax.
We've got to cut income taxes. Our income tax burden in this country is
ridiculous.
Destructive. It's really bad. So we've got to work out a way to cut
and
that.
Payroll taxes. So maybe a better way is to play around with the GST.
Totally. And what they need
pay
to
back
do,
the states.
Yeah, well, the problem is it's a state tax, and we need to rule that off the 10%, and then this becomes a federal tax.
Yeah.
What we've learnt from this episode is monetary policy should not be overused. The problems that we're seeing in the last 18 months.
Either way, either direction.
Exactly. So don't complain to me about 500 basis points of rate hikes when it came from zero and you're more than happy to, So that's the idea. I think they overcooked it. But that's another point we have to learn. The RBA actually did resist prior to the pandemic. But if the Fed and the Bank of England and the Bank of Japan are all at zero, there's only so long we can do that.
Yeah.
We get sucked into it, or else the Aussie dollar will go. So
out of control.
We've only got so much independence, but I have a feeling, and I hope this doesn't happen, but I got a feeling that when this episode's all said and done, whether it's in 3 years or 7, central banks will be doing a lot less in the future. And if we could also augment that with something like that, that would be great. And
because I'm in favour of it, you're in favour of it.
As long as we have the right structures in place. I'm in favour of industry policy if it is run by independent governing council and not the cabinet. I mean, in a way, what we want from our government is to focus on running government as effectively as possible, and do that well before you start coming up with your grand plans or changing things or whatever. And look, that's a level of sophistication we're a long way from in this country. But unfortunately, I think we're on the risk factor for a major crisis in this country is the highest it's been in 30, 40 years since the late 80s. And, whether that's, I'd probably put it as a 1 in 4 in the next 3 years. And that'll be where you sort of get real change. I hope it doesn't happen. I hope we get through this well. But
so is the risk factor, the outcome of the risk factor becoming not a probability but an event, is around standard living?
Well, that's already happening.
But at a greater rate.
What happens if the cash rate has to go to 6.5? You know exactly what that'll be, the same as 17.5 in 89. And I think we bounced out of the 91 recession for a range of reasons, not least all those reforms that Hawke and Keating did, but also stronger world economy, China. UK hasn't got over the GFC. If we have another financial crisis like the 91, that was our financial crisis. That wasn't a recession. That was a crisis.
It was a crisis.
Westpac. My father was on the board of Westpac.
I remember David Morgan, mate.
Yeah, it was tough. But I just don't think we'll bounce out of it. So I think this is one of the other things is that I've been saying, and when I can't really do this in the media, but when I speak to presentations is What will we pay to avoid that scenario? How much insurance would you pay right now? Would it be 2 rate hikes? And everyone, no matter how levered, I remember I was at a Noosa real estate agent giving this presentation, and they wanted to hear from this guy calling for rate hikes. When I explained it, they said, "Yeah, we'll take that 2 to avoid 6."
Yeah,
but of course the government won't take the 2.
They won't take any at the moment. And if they get one, they're going to blame the RBA. Which is going to create a confidence issue.
Yeah, for sure. And look, I'd never be calling for rate hikes to put the economy into recession. I actually think that the best chance of staying on the narrow path was a slightly higher interest rate going back.
Have we gone past that now?
The window's closing. Yeah, it's a good point. I feel, and this is more gut instinct, which is dangerous when you're an economist, but I feel that window's closing.
Yeah, well, I got my gut feeling is 2, which tells me that we're going to stay higher for longer.
Yeah, that's right, and I think that's painful. And Michelle Bullock at the last press conference at the end, it was a bit of a throwaway, and someone asked a question, and then she said, "I just think everyone wants this to be over with." It's just like we should have just hiked and we'd be cutting by now.
Well, that's sort of shorthand for saying exactly that.
It's exactly right, and we're dragging it out. I mean, is this 6-quarter, 18-month per capita recession where our living standards are measurably going down quarter after quarter after quarter any better than a short, sharp recession we bounce out of? I don't think so. I think we're so much more resilient than politicians feel that we are. And again, this idea of recession. So many Australians think about the early 90s recession as a recession. That wasn't a recession. That was a full-blown financial crisis. Our banking system stopped providing credit to the economy.
The financial stability was under attack.
Oh, totally. A normal recession, even a bad garden variety recession, is nothing like that. And in a world where we've got labour shortages, I think the main effect will be on all these zombie firms. We've got all these businesses that are going to start rolling over that haven't. And that will create some short-term unemployment, but that'll actually free labour up to go into other areas, which is this idea of the skills match thing. So, I don't think we're doing it the right way. I've been not being critical. I mean, I did worry about the variable rate exposure at the start. So,
as everyone did,
Yeah, and I had a higher cash rate than everyone, and that's sort of where it got to, and that's fine. But I think now it looks like we needed to go to 5.5 last year. And the question now becomes, how are we going to get out of this? And the next 6 months, next 3 months, I think are probably the most critical 3 months in Australia's modern economic history, probably since like the
91.
And maybe since the GST and all that sort of stuff. But it's all about how does the consumer respond to the tax cuts? Is this public sector jobs juggernaut going to roll on? And of course, the most important thing is, are we going to get the step down in inflation that basically the RBA forecasts need? They keep pushing out the return to target. They keep pushing it out. Their credibility, like they might be worried about tipping the economy into recession for that bigger picture issue. But in the end, they've got to get rid of inflation.
Yeah, because that's their job.
That's their job. And of course, that is what secures our prosperity. Anyone who thinks you can trade off inflation with anything is just doesn't know what they're talking about.
Is 2-3 the right range?
Yeah, it is. Still. It is, yeah. These people, I noticed Joseph Stiglitz was out here, and he was a hero of mine when I was a kid and studying economics, and he was a great academic. But I think, the fact that the world works differently to what academics think about has got him all sort of – the idea that it's just arbitrary is wrong. I can explain to you quickly why. The whole economy is based on relative price changes. When the orange price goes up versus the apple price, that sends signals to producers and consumers. There's billions of these relative price changes every day. The reason you don't have zero inflation is that our economy doesn't work instantaneously. These price changes take years to work their way through. So you need a little bit of inflation to pragmatically allow the economy to work. If you targeted zero, then any price that went up would be required to also have a price go down. And that would be bad for the economy. That would cause people to fall out of business and stuff like this. So it's a pragmatic number that's about price stability. That is, a little bit of inflation allows the economy to work. But all the evidence shows that any inflation, as it goes up, the cost to the efficient operation of the economy rises exponentially. And of course, the higher you put your target, the harder it is to hit. So 2 to 3 is I actually think 1 to 3 is the right number. Not that we're going to be bothering the 1 for a while, because we're in a new inflationary world. That change in dependency cycle that I talked about, that's also a shift in the cost of capital and the cost of labour. And it's on a one-way trajectory. It's not steep and heavy, but interest rates are going to be on average higher in 10 years than they are now. And, you know, we've just got to recognise the operational environment. If we want to what you do is you actually want government and the RBA not to be a factor. You want the private sector economy to go and do what it does, get onto this technology, make your production processes better, go and buy this stuff, go on holidays, do the things that we have done as Australians in the last 30 years, which makes it a great society, not a government-run country.
Warren Hogan, well, that was one hell of a speech, mate. It sounds like you're running for treasurer.
Sorry, Mark.
No, but
you got me going.
No, but that's what I wanted to do. I wanted to get you going because I wanted to get the Warren Hogan, the real Warren Hogan out. Thanks very much, mate. I really appreciate it.
Fantastic. Thanks, Mark. Thanks for having me on the show.